Hello, and welcome to myfinanceteacher.org. Today we're going to talk about our precious gold, silver, and gold miners. And what do you know? Gold is poking below $1,900 per ounce. It's actually been as low as 1882 a couple of days ago. So what does it mean? How low can gold go in the next few days? We're going to talk about that in this video, but before that, let me remind you that if you like the analysis, if you are interested in more frequent and detailed updates, you can join us at myfinanceteacher.org. As you see from the homepage here, I and my business partner update the members on a range of assets quite frequently. You can join us by clicking this register button on the homepage. Now let's get back into the video, and I'm going to start with the US dollar. In front of you is a daily chart of DXY. Over the last couple of days, US dollar broke above its 50-day moving average, and it's clear now, as I've suggested sometime in August, that the intermediate as well as the short-term daily cycles in the DXY finished in early September. Now let's zoom in a little bit and see that the ongoing daily cycle in the US dollar is now 22 days long. Since mid-2018, on average, these daily cycles lasted for 59 days, so nearly a couple of months. Which means I still expect maybe another couple of weeks at least of stronger dollar. And we see that the correlation between gold price and dollar, that's the bottom part of this chart, is still strongly into negative territory. So as dollar strengthens over the next maybe a couple of weeks, we're likely going to see our precious metals come down a little bit. On the other hand, though, I don't think dollar is going to strengthen for too long, because RSI is at nearly 63 at the moment. It's gradually getting closer to overbought area. And given that daily cycles in US dollar last for about a couple of months, in just over 1 week we will be somewhere in the midpoint of that cycle. Meaning that as we push further and further past that midpoint, dollar will be more and more likely to turn around and go back down. Now let's switch to the gold chart. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. Gold's daily cycle is now 42 days long, and as I was expecting, gold is now starting to decline into the end of its short-term daily cycle, as well as the end of its intermediate cycle, which is now 187 days old. And although gold has already poked through the lower range of the Bollinger Bands, it's not that important at the moment as the bands are quite narrow. So I would expect further decline in gold maybe in the next couple of weeks as dollar strengthens. Now, how far can gold go down? Well, one way to look at it is to have a look at Fibonacci retracement numbers. Often 38, 50% or 62% retracement are the most common ones, these three ranges in the middle of this band. So even if gold only comes back to 38% retracement, that's a price of 1840 over the next possibly a couple of weeks. And there is also a chance that gold comes down to retrace half of this height of the intermediate cycle, coming close to the area of around 1770, and that would also coincide nicely with this support zone based on a couple of these highs in April and in May. So to reiterate, potentially 1840 or even under 1800 is a likely end of the intermediate cycle in gold. Now that the 50-day moving average in gold has been broken, we might look at the next moving average below, which is the 200-day moving average. And even with the recent spike down a couple of days ago in gold, it was still around 9.5% above that 200-day moving average. And if we look at history, this is 2010-2011, that very strong bull market in gold. Even then, as you see, gold did tend to retest this 200-day moving average quite often within its intermediate cycle lows. And you see over here in mid-2011, it didn't actually come very close to retesting that 200-day moving average. But even then, the distance between that 200-day moving average and gold price was somewhere around 4.5%. So the fact that now gold is still over 9% above its 200-day moving average tells me that I want to wait a little bit longer to see if I will get a nicer opportunity. So with this in mind, let's have a look at GDX, gold miners. While gold has already broken below its Bollinger Bands, GDX is only starting to do so, and Bollinger Bands on GDX are relatively narrow as well. So over the next couple of weeks, I would expect GDX to come much closer to its 200-day moving average, which could be one potential support zone at around $33. Or alternatively, if we have a look at the Fibonacci retracement numbers, again, that 38% or 50% retracement are both quite likely, which are actually just above and just below that 200-day moving average, somewhere at 34.5 and at $31. Coming down to that 50% Fibonacci retracement would actually be also quite close enough to that $32 long-term resistance zone that we've seen on GDX for quite a few years. So retesting that one more time after doing it in mid-summer is also quite a possibility. As GDX over the next couple of weeks possibly comes down closer to its 200-day moving average, a lot of the gold miners will be giving us a very nice buying opportunity. And what we do at myfinancesteacher.org, besides talking about particular large asset classes, we also often look at particular gold miners and evaluate their fundamentals versus the ongoing stock price. So that's just another reason for you to consider joining us at myfinancesteacher.org. And lastly, let's have a look at silver. Daily chart of silver in front of you. We see that silver has also broken below the 50-day moving average, and it's even poking already a few times below its lower Bollinger Bands. But again, Bollinger Bands have recently been narrow, so even though we've seen a few pokes below the range, a further decline in silver is, I think, quite likely. We see that a couple of days ago, silver has also broken below the lower parabolic SAR, this dot that you see on the screen, which also indicates that a downtrend is ongoing. Similar to gold, once 50-day moving average is broken, the next moving average to possibly retest is the 200-day moving average. Currently, silver is still around 25% above its 200-day moving average. While again, back in 2011, during that strong bull run in precious metals, there were still periods when silver broke below the 50-day moving average and came a bit closer to its 200-day moving average. Back in early 2011, silver came to under 20% above its 200-day moving average during one of those retests. So the current situation of over 25% above 200-day moving average is still a little bit hot, and silver might actually come down over the next couple of weeks as US dollar strengthens a little bit. And looking at the Fibonacci retracement numbers, same as we did for gold, a 38% retracement would bring silver close to 22.9, and a 50% retracement, which is not impossible, would bring silver close to 20.8. So some really nice buying opportunities in precious metals are upcoming, I think, over the next 1 to 2 to 3 weeks. And if you want to have a hand on the pulse of the precious metals market, as well as a range of other markets, join us at myfinancesteacher.org. Click this register button, hit that like button on YouTube as well. Share your opinion on gold targets for the next couple of weeks in the comments below. Have a wonderful day and good luck in your trades.